Mortgage lenders are tricky folks. Now, sometimes what they do is just add the closing costs to the loan amount. You don't have to bring cash to closing, but instead of owing $200,000, you find after the refinance that you owe $205,000. Sure, you have a lower rate, but was it worth it? Maybe, maybe not. Be very careful and understand exactly what is going on in the process. Pay close attention to the amount of principal you owe on the old mortgage and the amount of the new loan. For example, the amount of principal I owed on my old mortgage was $368,000. The loan amount for the new loan was $368,700, which is within $50 of the payoff amount. Remember that the payoff amount is the sum of principal owed and the interest for the part of the month prior to the closing. So $700 for about half a month's interest is about right. But if the new loan balance had been something like $371,000, that would mean I was now adding some closing costs onto my loan balance, aka a no cash refinance, not a no cost refinance. We were burned this way on at least one of the two refinances we did back in medical school. You're hardly paying anything toward principal in the first few years of a 30-year mortgage anyway. Once you start adding costs back onto the loan, you'll really be rowing upstream.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.